question I have is when I was 14, 15, 16, 17, 18, I was not very disciplined. Like, don't get me wrong. I wanted to enjoy life, have fun. And then I look on your Facebook profile and the first picture is you shark diving and the second picture is you skydiving. So I think you're still having fun. But how did how did you remain disciplined enough to actually make this happen?
I mean, it comes from that budgeting mentality that mum taught me, right? Like, I divided all my expenses by 52. And then I give it to a separate account. Like, I have something like 13 accounts in my personal banking. Like, it's stupid. And it grows if I have another expense. It's a bit ridiculous in OTT, but it works, right? For every expense, right? And I just divide them by 52, direct debits if they can and whatever. And so for like rego insurance, 22.08 goes in there every week. Medical, 12.14. And I remember the numbers, but if you did them yourself, you could write them on a piece of paper, whatever.
Yeah.
And that's how I'm disciplined. I don't change from that, it works. So I can save like almost 80% of my income every week. It's pretty good.
That's insane. What I would say about this, what I've picked up so far is two really key things, is that you are very detail driven and also extremely motivated. And we're going to talk to, well, what was your first property? Well, tell us about how you went. What was the process involved? And as Joe said, you did it all yourself. So that's really interesting. How did you get that sorted?
You get started.
So number one, we went on a family holiday, but it was inspired by me buying a property, right? So I had booked in some inspections, and then we were forced to go on the family holiday to look at them, right? So the family holiday was for me to look at properties. It wasn't actually a family holiday. Everyone knew of it, right? We all knew what the purpose was. And so we went there, did a couple of inspections, viewed a couple of properties, right? And there was one that I really liked. And Mum was basically like, my advisor. She'd come in and we'd look at it. Dad, Jack, Amber would sit in the car waiting. I think they went into maybe one or two of them, maybe something like that. But normally it was just me and Mum, and definitely for the second one, it was just me and Mum because we flew down for that one. But the first one, we went around, we looked in them. First couple, and then last one we looked at, that was an off-market one, and we really liked that one. And the tenant was really good, so we met the tenant. He's in a good job up there, so security and that, and he seemed very pleasant. The house was immaculate, and it was reasonably priced as well, even when I negotiated it further down, right? And I was like, when we were going home that night, we were driving in the car towards Adelaide again, and on my phone I submitted the offer. And so they wanted 210, and then I offered 195, and then I think it was a little bit of back and forth, but then it said on that, so we got to 195 still. And that was pretty much the offer for the first one. So contacting the conveyance, pretty much, yeah. So
when you said, I like this one, I don't like this one, what was it that you liked and what was it that you didn't like?
Well, the one that I did like, it had those typical landlord sort of colours, like white, and it had really nice grass, and I could tell the place was looked after, right? So because I was buying it tenanted, I wanted to see that it was looked after, and some of the other ones we went at weren't as nicely looked after. No disrespect to those tenants, but they didn't present the property as well, right? And that's sales agent's loss, I guess, sort of. But it. Also, the style of the house, and the rent that they were receiving, those were the factors playing into it. The price as well. Some of them were just too low, where it was like, well, why are you trying to sell it so low, right? Has it been on market for so long that you're just trying to throw it away at this point and get rid of the sale? So the one that I did get, it was still an 8% yield gross, and it was a reasonable price for that area. It was in a really good spot, like right near a school. And, now like last week, a couple of weeks ago, there was a development, approval thing for a childcare centre that they're building at the end of this year, right across from it, like out the front door. So that will be great for rent, great for tenancy. Vacancy rates are already super low there anyway, so it'll be awesome to have that there too.
Unreal. Okay, so
unknown to me, lucky. First one.
Yeah, nailed it. And also the things that you're saying are not like, you didn't like the carpets, you didn't like the flooring. It was like you're actually talking about real property investing things that
like numbers. Yeah. Because my philosophy is I'm buying the numbers. I'm not buying, superficial metrics like, oh, the carpet's nice and fluffy. I'm buying things that give me money in my pocket. And, like that Rich Dad Poor Dad book, he talks about buying a property to put money in his pocket Same thing, right? Like I wanted to be making money as soon as I bought that property.
But I want to crystallize, what were the metrics, or what was some of the research you did on this first property? How did you decide the location? How did you decide the price you wanted to pay for it? All these things, or was it deliberate, or was it something like, oh, this is the price I'm going to pay?
So the price, I work it out the price not based on what the sale agent tells me, because they're going to want to get the best price, right? So they're going to, you know, spiel whatever they need to. So I work it out on, like, I want to, for resi, right? If I'm buying in regional SA, I want to be achieving an 8% yield. 7, like if you can get 7, that's okay, probably bare minimum. But 8% I was very happy with, and I'll do that. That's my sort of strategy. So, you know, you get, you know, the rent, divide that by 8%, and boom, there's your property price, right? So you do that. That's how you know your property price. You should purchase it at that point. If you can hit around there, that's pretty good, right? If you go a bit lower, awesome, better yield. A bit lower, like 7.9 is okay. Take that, you know, you win, right? That's pretty much next rent review, you'll get it up to 8. That's one factor. Another factor coming from McDonald's, and I think this doesn't just apply to McDonald's, right? You could apply this to Woolies or Coles, any big business. They have investors and like people on their teams in the corporate area who know a lot, and they get massive degrees, masters and PhDs of anything property related when they make investments. They're not just going to go and set up a massive $10 million shop in the middle of nowhere and they can't make money. Where I invest, I'll always invest where there's a McDonald's in close proximity, because McDonald's has like 20-year leases. They're not going to leave. They want a better business and they want to make lots and lots of money. So of course they're going to invest somewhere where it's going to make lots of money.
Is there a Bunnings as well, or no Bunnings?
Yeah, there's a Bunnings. Yep.
Yeah. Okay.
Lots of big business. See?
That's
what you look for as well.
The Bunning Index. Feel like
the Bunnings Index. Yeah, I have heard that.
Have you? I think I made it up.
Yeah. No, I read somewhere. There was a Bunnings Index. It literally was, yeah.
Maybe I didn't make it up. There is a Bunnings Index. It wasn't me. Okay, so you look for big corporates that are coming to town.
Yeah.
I mean McDonald's. There's a McDonald's everywhere though. Like,
well, not everywhere, because you can look in certain suburbs, right? They don't invest in certain suburbs because they know that there's going to be a certain epicenter. Follow the burger. Yeah. But, you know, like if you look at intersections, right, those are going to have a lot of foot traffic for retail. And generally retail is what drives the population too. You have industrial for like employability and stuff in areas. Like you have, you know, maybe a lot of workshops or whatever. People drive to that. They'll be willing to drive a long distance, but people want to go to the shops and whatever. So they want to be closer to shops. So people like to live in those areas too. Schools are generally in those areas. Like I think there's probably like hundreds of schools that are right across from a local shop, you know. So stuff like that. There's just good indicators when there's a business nearby too. And it needs to be a strong business with good financials generally. So like those blue chip things.
And the fact that you've transitioned from residential because you're too commercial, like you've just looked at it and said, you know what? The numbers don't make sense anymore for me at resi. So how did that help you open up borrowing capacity? Like how did it work from a resident? So how did that transition look?
Well, I'm pretty sure like Palisi goes into it a little bit. I think he was talking about it on something, maybe it was Everything Property Podcast, something like that. He was saying it somewhere where it was like your borrowing capacity doesn't necessarily grow, but you just don't destroy it like you do with resi, right? It's more of a capital game. So that's how I very much see it. Like it's not about, it's just a factor of time and money, right? So if I had $100 billion right now, I could buy heaps of commercial because I'd have, you're just doing 70% LVRs and you just copy, paste, copy, paste, copy, paste, copy, paste. That's all you're doing. And that serviceabilities, I haven't, like, you know, my lenders said, yeah, pretty much what you can do. The outlook is pretty positive.
Right. So what does that mean?
So like if I was to get a 30% deposit, I can just buy another commercial, depending on how much, of course, that 30% is, times that, you know, whatever number you need to get to your purchase price. And that's what it is again, right? So if I copy paste that enough times, I can just buy more, because that LVR is generally pretty positive anyway. Commercials are net yield. You're not going to have many costs at all. If it's a triple net yield, lucky. You get to have some good yields as well with that.
What's
and
a triple
cash flow is huge. Triple net yield is like
absolutely everything, I think, isn't it? They pay for
like pretty much everything. There's some little bits here and there where they might not. If it's a retail lease, you know, property management fees might not go onto it. Land tax sometimes, or strata sometimes, but you get pretty bloody close.
Yeah.
Yeah. Would you focus actually knowing what you know now, would you do what you've done? Would you change it up? Would you mix it up? Like, how would you look at that?
All right, so that's a good question, right? Because I can understand that. Resi, now commercial, it's harder to value from, like, you can just go to CoreLogic for resi and get your property value stuff, right? Pretty easy. You can't do it with commercial as easy. Right. So resi, I think it's great for building equity. That's what I'm using mine for, more or less now. That's sort of what it's just sitting in the background for. Maybe it will become more active for number 5. I'm not sure yet. I hope so. But number 5 will be commercial. Number 6 will be commercial as well. There's no outlook in the near future of converting to resi again. If I had some spare cash and I wanted to play with it and I didn't mind losing it, I might do a renovation deal to try and build some equity to get another commercial. But commercial's cash flow is such an awesome lifestyle changer that I just want to keep buying them. And they're easy to manage. They look after the place as well. And they're pretty good buildings generally because they're looked after very well.
What sort of mindset changes have you when you bought your commercial? Because you also, I want to unpack about the joint venture with your brother. But how do you think about commercial? Do you change do you have a bigger buffer in place? Like what is the difference between for you resi versus commercial in terms of your management of it?
Generally, they're higher value, so you have a little bit more cash buffer just for general costs as the month goes on until you get your profit back. I think, generally speaking, it's easier to manage because I've done numbers through resi as well. It's not like I was doing, anything crazy. I just kept doing value investing from resi and I could transition to commercial. It was very smooth. The first one, of course, was scary, as we spoke about before. First one's going to be scary. You can expect that. But numbers, I was already numbers, so it didn't make it huge of an impact. And I read so many commercial books too, it didn't make it that hard either. I just referred to them if I had a question. Because Google's not helpful with it. At least it might be more helpful now because I've done all these podcasts.
So what about vacancies? Like, is that not a big fear for you? Like 6, 12, 18 months vacancies?
Well, the lease terms are huge sometimes. Like the one, I think, the third one I bought, they are on a 3+3. And then the second commercial I got, that was initially, because that was just out of COVID, the travel agent had been on a 1 year and the optometrist had been on a 1 year as well. So both properties are dual shop fronts. Now, the 1 year leases, they were a bit risky, right? And I think that was priced into the purchase price. So that's probably why I got such a good yield on them too, because optometrist is medical, so you'd probably expect to pay a lower yield for that anyway. But because it was a 1 year lease, of course, you don't have to. You can just undercharge that price. But when I had done that, very happy with the outcome of that because I had been able to make the travel agent go to 3+3 years. So now they're at 6, so there's less risk in that travel agent one. Optometrist comes up for a review soon, and they're going to stay longer. They've already been there for 60 years, both tenants. So don't have to worry too long.
Yeah, they're going
to stay. The optometrists for sure. Like their degrees are long. They're not going to jump up and leave straight away. And in commercial, you see a lot of sophisticated structures like SMSS or stuff like that. So things like that, you see the tenants who behave in that manner, and you're like, well, I'd like those tenants because they're sophisticated. They know what they want. They understand some things better than your average mum and dad. Not to say they're unprofitable, the mum and dads, but they're riskier tenants because they're not going to maybe stay there for 10 years, right? I want someone who has the longevity to stay for 10 years or 5 years plus 5 years, 3+3. Resi is very similar, but you need the house. Resi is a lot more bones and structure with it. It needs to be a good house design, good house features, amenities, and things like that for people to stay. The tenant is important more in commercial. Like you can swap your tenant out quite quickly in resi if you're lucky. Yeah. Commercial, it's harder always.
There's an assumption that you should accumulate a few resi investments prior to commercial. Is this the case? And if so, why is this a common thing I keep hearing? At what point is it safe to enter to commercial or safe to entry to commercial?
No, I agree. I definitely think you should earn your stripes in residential. Definitely, it's an equity problem in commercial, right? You're not, unless you've given, tons and tons of cash, it's very hard to go straight into commercial. Also, you don't have the experience either. I think it's be unwise to go straight to it. There's a lot to lose in commercial, and there's a lot to gain too. That's the risk for reward, But residential, people understand the asset better anyway. So people, when they go to buy or sell it, if you had to get out of a bad investment, you could sell it and someone would probably buy it. Commercial, if you're selling a bad investment, no one on earth will buy that unless it's so underpriced.
Could take 12 to 18 months, could take 2 or 3 years to sell. If you and what are you doing in the meantime?
And all that time you're incurring the cost. Like you're paying council rates, you're paying this. It's definitely have resi first is my suggestion. Not just because I've done it. I think just from a risk mitigation point of view, it's a good idea.